Quick investing riddle before we begin. What's the only game where the same strategy that wins when you're 25 can bankrupt you when you're 65? The stock market. If you forget that time is your greatest asset. Now here's the real problem. If you're over 50 and investing like you're 25, you may be risking your retirement. Let me explain. Aggression at 25 builds wealth. Aggression at 65 destroys it. Let that sink in. For decades, financial culture has celebrated aggressive investing. Take risks. Swing for the fences. High risk, high reward. And when you're young, that advice can work. But if you're over 50 and still investing like you're 25, you may be playing a completely different game without realizing it. Because the rules of wealth building change with age. Not because opportunity disappears, but because risk becomes more dangerous than opportunity is valuable. Today, we're going to talk about something most financial influencers rarely mention: the psychology of risk after 50, and why legendary value investor Benjamin Graham's contrarian philosophy might be more relevant today than ever. Part 1. The age illusion in investing. When you're 25, the market can crash tomorrow and it barely matters. You have time. Time to earn more income. Time to recover losses. Time to let compounding rebuild your portfolio. If a 25-year-old investor loses 40% in a market crash, they still have 30 or 40 years of earning power ahead of them. But after 50, time is no longer your biggest advantage. In fact, time becomes the one resource you cannot replace. A major loss at 55 doesn't just hurt your portfolio. It shortens your retirement options. It increases stress, and it forces difficult decisions about work, lifestyle, and security. Benjamin Graham once warned investors about speculation disguised as investing. Many people believe they are investing, but in reality, they are simply taking risks and hoping for good outcomes. At 25, that gamble might work out. At 55, it can become a financial disaster. Part 2. The problem with young investor advice. Modern investing advice is often built for young audiences. You hear things like, just buy growth stocks, go all in on tech, hold through volatility, put everything in the market. And for younger investors, those strategies can make sense. But the financial industry rarely adjusts that message for people approaching retirement. Because aggressive strategies look exciting, but risk management looks boring. And yet, protecting wealth is one of the most important financial skills after 50. Benjamin Graham believed the first rule of investing was preservation of capital, not maximizing returns, not chasing trends, not predicting markets, simply avoiding permanent loss. Because once capital is destroyed, rebuilding it becomes much harder, especially later in life. Part 3. The psychology of risk after 50. Here's something many investors misunderstand. Risk is not just mathematical. Risk is psychological. When markets crash and you're 25, you may feel nervous. But when markets crash and you're 60, it feels completely different. Because the emotional stakes are higher, you start thinking about retirement income, healthcare costs, supporting family members, unexpected emergencies, and suddenly the volatility that once looked exciting starts looking terrifying. This emotional pressure can lead to one of the worst investing mistakes: panic selling. Many investors say they can handle risk, but when markets fall 30% or 40%, emotions take control. They sell at the worst moment, and that temporary loss becomes a permanent one. Benjamin Graham famously described the market as Mr. Market, an emotional partner who offers prices every day. Sometimes Mr. Market is euphoric, sometimes he's depressed, but Graham warned investors never to let Mr. Market control their decisions. After 50, emotional discipline becomes just as important as financial strategy. Part 4. The hidden danger of sequence risk. One of the most dangerous risks for older investors is something called sequence of returns risk. This risk has nothing to do with average returns. Instead, It focuses on when losses occur. Imagine two investors who both earn an average return of 7% over 20 years. Sounds identical, right? But if one investor experiences major losses right before retirement, the damage can be devastating, because withdrawals begin at the same time the portfolio is shrinking. This creates a destructive cycle. Losses reduce portfolio value, withdrawals accelerate the decline, and recovery becomes extremely difficult. In other words, bad timing can destroy a perfectly good investment plan. This is why aggressive strategies that work for young investors can become dangerous later in life, because retirement portfolios must survive not just growth cycles, but income withdrawals. Part 5. Graham's Contrarian Approach. Benjamin Graham believed investors should behave differently from the crowd. When markets are euphoric, they should be cautious. When markets are fearful, they should be patient. But Graham also believed something else that modern investors often ignore. Investment strategy must match the investor's situation. He divided investors into two types: the enterprising investor, who actively researches opportunities, and the defensive investor, who focuses on stability, diversification, and protection. Most people over 50 should lean toward the defensive strategy. That doesn't mean avoiding growth completely. It means balancing opportunity with protection. Instead of asking, "How much can I make?" the smarter question becomes, "How much can I afford to lose?" That single mindset shift changes everything. Part 6. Wealth Protection versus Wealth Building. Your 20s and 30s are about building wealth. Your 50s and 60s are about protecting it. This is the stage where diversification becomes critical. Stable assets, income-producing investments, lower volatility, not because growth stops mattering, but because survival becomes the priority. A portfolio that grows slowly but safely can be far more powerful than one that swings wildly, because stability allows you to stay invested, and staying invested is the real engine of long-term wealth. Graham believed that investors should aim not for maximum profit, but for satisfactory returns with minimal risk. That philosophy may sound conservative, but for investors approaching retirement, it can be life-changing. Part 7. The Power of the Second Curve. Here is something almost no financial influencer talks about. After 50, wealth should follow a second curve. The first curve of your life was about accumulation, working, saving, investing, taking risks. But the second curve is different. The second curve is about strategic positioning. Instead of asking, "How fast can my money grow?" you begin asking, "How durable is my wealth?" Legendary investors understand this shift, because wealth is not destroyed by bad markets alone. It is destroyed by fragile strategies. Think about it this way. If your portfolio requires perfect market conditions to succeed, then it isn't a strategy, it's a gamble. The second curve is about anti-fragility, portfolios designed to survive uncertainty. Assets that produce income, investments that don't require constant market growth. Because the greatest financial luxury in life is not making money. It's not needing the market to cooperate in order to feel safe. And this is where most investors make a critical mistake. They keep playing the first curve game long after they should have transitioned to the second. Part 8. The Wealth Trap that Destroys Retirements. Now let me tell you about something that quietly destroys millions of retirements. It's called the wealth trap, and it happens when successful investors become overconfident in strategies that worked in the past. Maybe they made great money in tech stocks. Maybe they did well with real estate. Maybe they had a decade of strong market returns. And because those strategies worked before, they assume they will always work. But markets evolve, economic cycles change, and strategies that build wealth are not always the same strategies that protect wealth. Benjamin Graham warned about this decades ago. He believed the most dangerous investors were not beginners. The most dangerous investors were experienced investors who stopped adapting. Because confidence without caution becomes complacency, and complacency leads to catastrophic risk. In fact, many of the worst financial losses in history happened not to amateurs, but to people who believed they had already mastered the market. That's why humility is one of the most underrated financial skills. Because the moment you believe the market cannot hurt you, that is usually when it does. Part 9. The real secret of long-term wealth. If you study investors who stayed wealthy for 40 or 50 years, you will notice something fascinating. They were not the most aggressive. They were not the most brilliant. They were not the ones predicting every market move. They were simply the ones who survived every cycle. Bull markets, bear markets, recessions, inflation, financial crises. Instead of trying to win every year, they focused on never being knocked out of the game. Because wealth is not built by winning once. It's built by staying invested long enough for compounding to do its work. Think about Warren Buffett. His fortune was not created by one lucky investment. It was created by decades of uninterrupted compounding. Time, discipline, patience. Those three forces are far more powerful than any hot stock tip. And that is the real lesson Benjamin Graham tried to teach the world. Successful investing is not about excitement. It is about endurance. Conclusion, the real goal. Aggression at 25 builds wealth. Aggression at 65 destroys it. The biggest financial mistake people over 50 make is assuming they're still playing the same game they played in their youth. But investing after 50 is no longer about chasing the next big opportunity. It's about protecting decades of hard work. It's about building a portfolio that can survive uncertainty. And most importantly, it's about designing a strategy that lets you sleep peacefully at night. Benjamin Graham once said, "The essence of investment management is the management of risks, not the management of returns." In other words, the investors who win in the long run are not the ones who chase the biggest gains. They are the ones who avoid the biggest mistakes. And sometimes, the smartest investment move you can make is simply taking less risk. Now, before you go, let me ask you something important. If you are over 40 or approaching retirement, the information we just discussed could literally change the financial future of your family. But here's the problem. Most people don't learn these lessons until it's too late. That is exactly why I created this channel. On real-world investing, we break down the strategies used by legendary investors, economists, and financial thinkers, but explained in a way that actually helps real people build real wealth. No hype, no speculation, no gambling disguised as investing, just the timeless principles that have built fortunes for generations. So if you want to understand how the richest investors think, how to build income-producing portfolios, how to protect wealth during recessions, and how to design a financial life that gives you real freedom, then do 3 things right now. First, hit the subscribe button, because the next videos on this channel are going to reveal strategies most financial advisors never explain publicly. Second, like this video. That tells YouTube to show it to more people who are trying to build smarter financial lives. And third, I want you to comment one word below. Discipline. Because the investors who win in the long run are not the smartest. They are the ones with the discipline to stay calm when everyone else panics. And in the next video, I'm going to show you something that might completely change how you see money. The 3-bucket strategy that many millionaires quietly use to protect wealth during market crashes. Trust me, once you see it, you may never look at your portfolio the same way again. So subscribe now, and I'll see you in the next video.